Welcome to Talk Tickers. Today, we're digging into a real head-scratcher, the Q3 earnings for Ollie's Bargain Outlet. They delivered a fantastic report, and the market, well, it pretty much hated it. Let's break down what happened. All right, let's get right to it. The headline number, Ollie's reported adjusted earnings per share of 75 cents. And that's not just a good number, it's a great one. I mean, that's a huge 29% jump from last year, and it solidly beat what Wall Street was expecting. So right out of the gate, that's a clear win on the bottom line. But, and this is where it gets weird, this is what the stock did on the day of the big news. It gapped down in the morning and ended the day down 4%. And on really, really heavy volume too. So what gives? A company beats earnings, raises its forecast for the future. That's supposed to be a rocket ship for the stock, right? Not this. This is the puzzle we're going to solve today. Okay, first things first, let's just establish the facts. Because if you just look at the numbers on paper, this was an absolutely fantastic quarter for Ollie's. So they nailed the earnings beat. Revenue came in at over $613 million, which was pretty much exactly what everyone expected. And check this out. Comparable store sales were up 3.3%. The best part? That was driven by more customers actually walking through the doors, which is exactly what you want to see. And, management was feeling pretty good about it. On the earnings call, the CEO's tone was super bullish. He talked about strong momentum, and this is key. They actually raised their guidance for the full year on both sales and profits. So you've got great numbers, happy management, a higher forecast. Why on earth did the stock trade down? Well, the market's reaction tells a totally different story. It suggests that the big investors were looking right past all those shiny headlines. I mean, just look at this volume. The stock traded more than triple its normal daily average. That's not just a few people selling off. No way. That kind of volume tells you that significant institutional money, the big funds, were heading for the exits. Okay, so to figure out what could possibly scare them off, you first have to really appreciate the bull case for Ollie's. And it's all centered on one thing: aggressive, relentless expansion. They've got this really clear three-part playbook they call their growth algorithm. It's simple. Step 1, open new stores fast. Step 2, get more sales out of the stores they already have. And Step 3, improve profitability across the board. And when we say fast, we mean it. The scale here is just massive. Management recently jacked up their long-term store target from an already ambitious 1,050 stores all the way up to 1,300 locations. They see a huge runway ahead of them. And this isn't some far-off fantasy either. It's happening right now. They've already opened a record 86 stores this year alone, partly by being smart and snapping up old leases from Big Lots. Plus, their Ollie's Army loyalty program is absolutely exploding with new members who, by the way, spend over 40% more. It's a powerful growth engine. So that all sounds incredible, right? But Wall Street was reading the fine print, and it seems they found a few things hiding in the details of the report that made them pretty nervous. All right, this right here is the crucial point. It's the difference between profit on paper and actual cash in the bank. So while the income statement looked great with a profit of $46 million, the company actually burned through $26 million in cash this quarter. So where'd the cash go? Mostly into buying inventory and paying for all those new stores they're building. And the worries didn't stop with cash flow. Investors also noticed that gross margins dipped just a little bit, which the company blamed on supply chain costs and tariffs. And then there's the elephant in the room. The stock's valuation was already pretty rich after having such a great year. This chart really puts it all into context. You can see that while Ollie's has been a big winner over the past year, up over 16%, it has seriously been lagging the market and other retailers more recently. That kind of underperformance makes a stock really vulnerable to profit-taking the second any weakness shows up. So let's put it all together. You've got the bull case with this amazing growth story up against a bear case focused on cash burn and a high price tag. What's our final call on Ollie's? The whole debate really boils down to one question. Do you believe that the long-term story of opening hundreds of new stores is powerful enough to make you overlook the short-term cash issues and the stock's premium price? That's really the whole ballgame right there. For next quarter, we're expecting their comp sales to land right in the middle of what management is guiding for. So let's call it around 2.5%. As for the stock, we think it's going to be pretty range-bound for a while, as the market basically waits for proof that Ollie's can start generating more cash to justify a higher valuation. So with all that in mind, our final rating on the stock is market perform. Look, the company is executing its growth plan really well, there's no doubt about that. But the current stock price already reflects a lot of that optimism, which to us creates a pretty balanced risk-reward profile right at these levels.
And as always, please remember, this is not financial advice.